Good afternoon, everyone. Welcome to this panel at the Virtual FinTech Fair. My name is Helene Li. I'm the General Manager of the FinTech Association of Hong Kong and delighted to be the host and moderator for this session. Now, we've gathered quite an international panel of experts all the way from Frankfurt to Hong Kong. And thank you for our European panelists who is waking up specifically early for this. So let me just give a quick introduction, before we jump right into the panel. We've got Paolo Sironi, a thought leader, a big influencer in the space, and also one of the thought leaders at the IBM Institute. Paolo, would you like to say a few words to the audience?
First of all, it's never too early to join Asia for this wonderful conversation. And I am the Global Research Leader in Banking and Financial Markets for IBM. That means I coordinate the thought leadership for the FinTech transformation and the transformation of the banking and financial market sector. Also author of financial literature that I believe you might have seen around already for some time.
Great, thank you. Now coming over to closer to home, we've got Eric Poon, who is from the family office space, and Mikaal Abdulla, one of our favorite fintechs in Hong Kong, from 8 Securities to SoFi. So Eric, say a few words to the audience about who you are.
Thank you, Helen. My name is Eric Poon. I'm based in Hong Kong. I'm the Vice Chairman of the Family Office Association in Asia. I have 26 years of experience looking after private equity, wealth, and asset management industry based in New York, Asia, and also Canada. I've been with JP Morgan, Goldman Sachs, BlackRock, and a few others. Aside from work, I'm an advisor to the UN, United Nations, also Hong Kong Venture Capital Association, the ATEC Startup Competition for the Ivy League School in the US, and also I'm part of the Cyberport Investor Network, and also Vice Chairman of the Private Banking Association in Greater China. Pleased to be with you all. Thank you.
Thank you, Eric. And last but not least, Mikaal, can you say a few words to the audience and let them know who you are, sorry.
Sure, thank you. So by way of introduction, I started my first company, 8 Securities in Hong Kong in 2012. So it was one of the first licensed fintech companies in Hong Kong and really focused primarily on mobile-only investing. Approximately 80% of our customers are in their 20s and 30s. Last year, we were approached by SoFi, Social Finance, a large US consumer fintech, which ultimately acquired 8 Securities, and that deal closed a few months ago. I now run SoFi's international business, which is a new line of business for them. And then prior to starting 8 Securities, I was at E-Trade for 10 years, where I looked after E-Trade's international business, and very happy to be here. Thank you.
Thank you, Mikaal. I think, among the three of us, there are more years in the finance industry than we care to remember. I'm a management consultant turned banker, alumni of JP Morgan and BNP Paribas, all in the wealth management space, before taking on the role at the FinTech Association of Hong Kong. So let's just jump right into it. I think COVID has been an accelerator in many ways. It has driven anyone that has a digitized offering to higher levels of business. How have you observed that in your different fields, like from family offices as capital owners, or Mikaal, as really the service provider, and Paolo as really, kind of researcher, thought leader in the space. Maybe we start with Eric.
Sure, thank you, Helen. Since I kickstart, maybe I give an extremely brief history about Robo Advisory. It started off around 2008, and money started coming in 2010. In terms of some quick statistics, I have read that Robo Advisory took on about 60 billion by year end 2015, grew to about 2 trillion 2020. It was projected to about 7 trillion and maybe more by 2025, probably quite a bit more. As a family office, there are different angles people could look at. One, as a shareholder and investor to this platform. 2, as a user to this platform. And 3, as an advocate of this platform that could influence the whole ecosystem. If you look at private wealth and high net worth individual, I read research that stated 39% of the high net worth prefer to deal with a private banking relationship as key gatekeeper for these investment in these complex market. About 48% in Singapore and 42% or so in China that deal with, rely on their business network to originate deal. And to answer that specific question Helen posted, I think COVID would expedite and accelerate the use of high net worth family offices, of these wealth tech and robo advisors. Let's start with the investor angle. Mikaal mentioned about E-Trade. I read in a research report that by Medixi that E-Trade was sold to Morgan Stanley earlier in the year, I think for about $12 billion, if I read it correctly. And also, you look at the potential IPO of Ant Financial, which will be gigantic. I'm sure you see it all over the world. And if you look at Bloomberg, Reuters, and many other public domain, you see Lufax is also trying to IPO. So exit for family office and investors are critical. So if we see more wealth tech and robo advisors, including X Securities, Mikaal, which congratulations on the great exit, I think those are important. And I think COVID accelerated that. Secondly, as a user to these platforms, I think people cannot go out, they cannot see their private bankers. So naturally, people would use more wealth tech and robo advisory in that regard. Advocate the same thing. If one uses it well, they would refer to other friends. You know, also things to be aware of. I mean, if you look at robo advisory as a private investment, historically, the private equity would outperform the stock market by about 6% per annum, give or take. That's what I read in the research today. And I think for people to invest in these wealth tech and robo advisory, if they are a user as such, I think that would further populate that in that regard. I think if you look at the IMF latest report, they projected 2020, the economy could contract about 4.9%. And in the same report, IMF was stating that I think developed market would contract more, maybe 8-9%, and then the emerging market would contract a bit less, and China would be a bit more stabilized, given they came out of the COVID a bit quicker. So I think if you look at that landscape, it's all the more important to give the soft touch as a wealth tech platform and as a robo advisory platform, because I think the practicality of these platforms are extremely important, especially in the COVID stage. Let me stop here so that other panel speakers get to speak a bit as well. Thank you, Helen.
Yeah, thank you, Eric. I think you set the scene very well in terms of all the data points around the increase in the market share of robo-advisory and digitized wealth management solutions. I'd like to turn to Mikaal. Your exit of X Securities couldn't come at a better timing. Maybe you had a crystal ball looking at it and all that. But, what has been the trends that you have observed, and how has SoFi International now capitalized on some of that?
So thank you. I think one of the things we've really experienced, which I think is not unique to us, but I think many consumer fintech companies would say have sort of similar stories, is year over year, our transaction growth, whether it's talking about trades, turnover, deposits, are up across the board about 800% year over year. And we're up about 400% even compared to Q1 this year. So there's been an enormous surge in consumers adopting digital financial services. In our case, it's investing. I think the fact that we're a mobile-only business has certainly helped. I think potentially in the sort of political environment in Hong Kong today, I'm not sure it hurts that we're a U.S. company doing business there today, but I think by and large, we've seen an enormous surge in adoption. I love the word you use, an accelerator. There's no question in my mind that this was inevitable and would have happened. It's just almost sort of cutting a year or two out of the process and just happening much sooner than we thought. So from our perspective, it's been immense growth. We're really fortunate, but again, not unique to us. A lot of my peers in consumer fintech are seeing the same things.
Right. Thank you, Mikaal. I'd like to turn a bit to Paolo, because while it's been an accelerator, I'm sure the COVID also exposes quite a lot of cracks in our current system. and a digitized solution seems to be a way to deal with that. What are your perspectives from, you know, the kind of research and observation that you have made?
Well, the COVID has been certainly a very sad and unprecedented event. But it is a part of the human being to learn also from difficult situations. And if I could say, I believe that there are some lessons learned in the COVID story that actually are well reflecting some of the content of my literature, in particular the FinTech innovation, looking at what is going on digital, and the latest financial market transparency, which is about what should go on digital as well as in analog wealth management. Now, these three lessons learned from the COVID outbreak and the way governments, people, organizations had to face it are transparency, openness, and advisory. And I think I want to detail them a little bit so that you understand why these lessons learned are fundamental to move digital wealth management forward. Transparency is fairly clear. It's the key principle that generates trust in an economy, on a platform, in an ecosystem, therefore between an advisor and his client. We saw how difficult it was for government to communicate transparently to the individuals, the numbers, the situation, what was going on, especially because uncertainty was very high. Now, the chairwoman of the International Monetary Fund, a few months before the COVID started, in a CNN interview, said, uncertainty is the new normal. And it is. We always forget. We want to live in the normality. We want to pretend capital markets are not uncertain, but they are. And today, the economy and our health situation is very uncertain. So without transparency, there can be trust. At the same time, digital wealth managers and analog wealth managers need to focus on transparency because this is the way they can build the trust, especially when relationships are distant, whether they are due to the social distances and the lockdown, or because digital is creating a disintermediation of that human relationship, and there's a distant moment between the client and the digital platform. So transparency means make sure that you simplify the language, you simplify the product, and you clearly explain to the people, your customers, what are they paying for the advice and what you effectively know and what you don't know about the future. The second we said is openness. Therefore, transparency, openness, and advisory. Openness is fundamental during the COVID because it means that governments need to share data with the research centers, they need to share data with the health officials, they need to share data with the universities, with technology companies, because only by bringing together every piece that we know and that we are seeing, using this data collectively, we can find much faster than thought a solution to the COVID problem. At the same time, banks need to make sure that they become much more open in the way they use their data internally, because they need to blur the lines among institutions. Wealth management benefits from that because they need to bring together credit, the liabilities, and the assets of the families, for example, to build an holistic approach. But at the same time, financial institutions also need to be open for the ecosystem, is open banking, because that's the only way digital transformations can accelerate to plug in new ideas that generate and spring value for the final customers. So transparency and openness are two things we learned through the COVID that are also fundamental to shape the future of digital wealth management. And the third one is, if you like, the most direct. I remember the response of South Korea to the outbreak and an interview on CNBC of the foreign minister of South Korea that talked about transparency, openness, and advisory. She basically said that it is important to remind everybody about the fact that our behavior matters. So, you know, we might decide that we need to wear a mask and then we forget about it. It's very easy to go back to, you know, a relaxed type of approach. And the same goes with investing. We might have learned a few rules and figured out how to start investing, but then time goes by and we forget the reasons why we made some choices. So we become exuberant or extremely concerned when market shifts, and therefore we start damaging our future opportunities because we don't know how to build sufficient awareness and appropriate behavior. That's why the role of wealth management to generate value is about the advisory relationship. Relationship is the key. It is not the product. It is not the frictionless user experience, no matter how important it is transparent and open advisory mechanisms. So if the COVID taught us something, is that relationships were important and more important than anything. And that's the reason we are here in this webinar, because still we want to be connected, see each other's, share views.
Absolutely. Thank you so much. I love your sentence about how uncertainty is the new normal. And I actually would like to turn to Mikaal. That actually brings me to my next point, because despite all the shiny new technology that one can build in, that relationship, that trust, it's still at the core of any business in wealth management. Okay, you know, it's not just chasing the next in technology. Now that means a high degree of personalization as well. And how does that reconcile with your offering, Mikaal? I'd love to see if there are any specific challenges between that personalization and that automation that you are seeing, particularly in the wealth management space that is so important, right?
Yes, exactly. And I think the first thing, and I often say this, customers, consumers don't care about technology. They could care less about what technology we're using or the technology that any of our competitors are using. And often when you launch a business, you can get caught up in trying to build the most, innovative product with a definition of it being, the newest technology, the most scalable technology. Those things are of course important, but they're important to you as a business. Customers don't care. They just want your product to be three things. It has to be fast, affordable, and transparent. I think in the case of financial services, that becomes even more important. When we talk about the evolution of the product, we've gone through this phase where I sort of call it Robo Advisor 1.0. And when you had some of the pioneers in the US, such as Wealthfront and Betterment launching products, it was basically packaged portfolios. So maybe you have 5 different portfolios of exchange traded funds. A customer tells you their risk tolerance, time horizon, and so on. And then you align them with a portfolio that is managed for them. Pretty simple, not particularly difficult for a business to implement. That was the sort of first generation. But what we're seeing, and maybe it's a little bit unique to us because we have brokerage next to the Robo Advisor, is customers do want personalization. And we're moving to a view that maybe every single customer's portfolio isn't the same. So we're not talking about 5 portfolios anymore. We may be talking about 20, 30,000 different portfolios. And I say that because most customers, when they open an account, have a view that they may want to hold a few stocks. So let's say, for example, they want to hold Amazon and Tencent in their portfolio. It's perfectly fine. So they buy those stocks, they hold them. The problem then is in the questionnaire, they've told us that they're long-term conservative. Now there's an issue there because the stocks they're holding are not in alignment with their goals. They don't have a lot of diversification between Tencent and Amazon, and they're relatively risky. So when you think about that, the idea then is to answer the question, now what? So I've got these 2 stocks that I know I want to hold, but now what? And so the personalization then comes in to say, here, evaluating your portfolio and evaluating the stocks you want to own, we suggest you own this ETF or this stock in order to build in the diversification and mitigate the long-term risk that you would may face otherwise. So we do think personalization is important. I think we're moving beyond Robo 1.0, moving into 2.0, and 2.0 is, I think you nailed it, all about personalization and meeting customer needs the way they want them met.
Yeah, thank you so much, Mikaal. I couldn't agree more. Eric, I'd like to turn to
Yes.
you and look at the family offices, the capital owners.
Yes.
How are they seeing wealth management, that is highly personalized kind of industry? They need a lot of hand-holding from the relationship managers. How are they factoring in this automated service offering?
The way I personally see it is that, there are more than 100 robo-advisors in the world from, I think, 15 countries, according to my research. And I think in addition to what Paolo and Mikaal talk about, transparency, personal touch, I think another keys are product offering. I mean, we could put robo-advisory aside because, that is quant and the engine and all that, which has been quite prominent for the better part of 10 years. But what I want to talk about is the greenfield in this industry, which is the ultra high net worth who look at the private deals. Because I think that is the total greenfield, the dark horse, if you will, in that industry. For example, I think people love to invest as a club. And I think for Robo Advisory to cover the low cost, I think as low as 0.25 to 0.4%, right? That segment is really crowded. I think what would make the tipping point is if any of the platform can tackle the private deals. And I think that would be an important part that people should think about. For example, if you target accredited investor, professional investor, use a significant wealth tech platform that could store some of the private deals, updated it, maybe even use notifications. You know, at the end of the day, I think that could truly break down some of the brick and mortar pain points that people used to do. Obviously, the personal touch is key. I mean, nobody will invest maybe $5 million online, right? And no one will do that. But if someone can sit in that villa in Bali, you know, looking at certain deals when he or she is free, and then talk to the private bankers, then that would be all the more effective. I mean, some of the data room are virtual, so people could look at the data room and look at some of the stuff virtually. So I think that type of space would be an interesting tipping point for people to grow in the future. And I think the personal touch, as long as it's secure, everything, I think the second gen and the third gen would use it probably a little bit more than the first gen of the wealthy individual. So I think net, I think family office would be open to it. The key is whether there are interesting products or private deals that are on there that would attract them to keep on going back in to that app to use it. I think that would be the tipping point. Aside from what Mikaal talked about, I think it's always there. Thank you.
Yeah, thank you, Eric. I think that's a very interesting green field, you know, the private club deals that have been like purely personalized process. Now, I'd like to turn to, you know, Paolo, you know, on this. Now, a hybrid model, you know, or you know, moving towards like a hybrid model is probably the next step, you know, the 2.0 or the 3.0, but there is a huge cost to serve element to this. Okay. It will be a bit more costly. So how do you see that in terms of the research that you've been doing in this?
Well,
is hybrid the future?
I would answer this question reconnecting to what Mikaal and Eric just said, because I want to strongly disagree with the previous statements, because they largely locked themselves into a product conversation. Even a model portfolio, how modified it is a product conversation. And even in the analog world, wealth managers realize that products and portfolios do not personalize and do not diversify, and especially at these embedded fees that don't generate value for the institutions at the same time. So in order to let you understand why personalization has to be different and what does it mean for an hybrid model, I will make a little bit step on the side to discuss what is really going on globally on the transformation of the business model of banks, of which wealth managers. And is what I call the inversion of the business model, which is due to this new normal we've been living in after the outbreak of the global financial crisis and the fact that uncertainty is becoming de facto the norm or the new norm. The inversion of the business model is the following. Largely speaking, financial institutions used to make money with two types of strategies. One is information, that means interest rate margins, basically lending to families and to corporations. But since interest rates are plummeting to zero, the negative territory, and the cost of capital is basically going up, it's very difficult for banks to reward the shareholder value after the price for risk. And that's why you see that most of these institutions are effectively moving towards intermediation margins. They are made of payments, which have zero margins going forward, and something else that is very important, which is wealth management, made of investment products and insurance contracts. That is the reason why wealth management is becoming the heart of the financial institution. So it's an inversion from the credit institution into a provider of services which is centered around wealth management. However, also wealth management has its own troubles because due to the transparency regulation, margins are compressing. Due to the vanguardization, so the extreme competition in the US, margins are compressing. Due to the fact that quantitative easing is so overwhelming, the correlation among the assets becomes, if you like, very homogeneous. So it's very, very difficult to differentiate. But here there is an important opportunity that some large banks, some we mentioned them before, started to realize. And it's the fact that if you redesign holistically a financial institution, and that is what digital wealth management should be able to do and facilitate, you will be able to remunerate the credit function by plugging it inside a wealth management conversation, so that after you do your risk management, the remuneration comes from the relationship with the client. Because you see, products are commoditized. Even private deals are fairly commoditized. So they can't personalize. The real personalization comes from the liabilities of families, the liabilities of corporations, which is the goal-based investing principle. To put it mildly, we are all different because we have different mortgages, we have different number of children. They are lovely assets, but also liabilities. Even our human capital is a liability because we need to invest for education. That is the part that personalizes. And that is why, as I indicated in my literature years back, and I reveal again in my last financial market transparency, the planning is more important than the advisory. So what Robo Advisors had to do, but didn't do, is to move and shift towards a planning relationship. Now, what happens here is that when Silicon Valley looked at the fintech, they gave money. I remember when I participated to the first conferences, they were all looking at the Robo Advisors because they saw the volume, but volume is a commoditized business to the limit. You don't diversify. You don't diversify in the sense of differentiate yourself. You don't personalize. Planning instead is a more complex exercise. So they thought the human relationship is overwhelming. They will not scale up as expected, so we invest less money. However, what is now revealed is that only those robo-advisors and those banks that learn about the planning principle, which embed deep personalization through the liabilities by recombining the credit function, which is very important for the ultra net 2 and the affluent with the investment, will be able to differentiate themselves against the Uber games of companies that can only basically play with the asset. Now, this is where digital technology should help, because as planning is a complex exercise, that will lower the effort of advisors in a B2B model, which is a hybrid model, in order to craft and deliver that super important conversation. So you see that only by understanding that personalization comes from liabilities and not assets, you give value to the effort of different investments on digital, and you understand why the hybrid model stayed and remained the only one that ultimately can justify the fees, whether it is done through a human to human, a machine to human, or a human plus machine to human.
Thank you so much, Paolo. I think that's a very interesting perspective. I'd like to turn to Mikaal, because we got actually a few burning questions from the audience. But before we go into that, I'd like to just, drill down a little bit from your perspective, Mikaal, around the hybrid model, whether it's human and machine to human, and what does that imply in terms of the cost to serve for your business model?
So I take a fairly extreme view that I think advisors' days are numbered, and it may be a very sort of generational thing, but it reminds me of when I was at E-Trade and when we launched brokerage in 99. Everybody called it a fad. Everybody said people are always going to need a broker. They're going to need advice in constructing a portfolio. Fast forward, I'm sure nobody on this panel, probably nobody in the audience knows a stockbroker anymore. Technology just avoided the necessity to have one. And now the argument with wealth management is, oh, this is different. I'm not sure it is. Yes, it's a bigger market and it's a bigger opportunity. But if you look at China and sort of directionally, whether you're a high net worth individual or you're a consumer with $100 to invest, generationally, young people want to use a mobile device. They do not want to go into a branch. They do not want to pick up a telephone. They certainly don't want to go through a planning exercise with an advisor. And again, yes, I acknowledge that high net worth individuals may have more complex needs than the average consumer. But I think unless you're going to meet that need with technology, with superior user experience, and it's entirely digital, you're going to be at a disadvantage. So a bit of an extreme view, but I believe it.
Yeah, I think it's a bit of an extreme view, but I think the following question actually from the audience, which is, I believe is for all three of the panelists here. I would like to take that first because that actually leads on well into some of the areas that we like to explore. Shirley Xu from the audience, she wants to know, with more digital trading platform and an e-allocation platform, the role of wealth management may involve teaching the investors, educating the investors how to use the platform so that they have everything available on their fingertips. So do you have an advisor who specializes, break down the black box of tech platform, hybrid or brokerage, and robo advisory, and the personalization of risk profile? Who wants to take this first?
Okay, I do. And I start from the concept, which connects with what Mikaal just said. There is a substantial problem in the fintech innovation space when looking at investment management, because Silicon Valley largely misunderstood a fundamental element. This one, which is my mobile that all kids want to use, is a pull technology, is a technology of the demand. While most of the revenues generated in the wealth management space are a push economy, it's an offer-driven business. Every wealth management knows. Everybody that has talked to, whether a young client or an old investor, realize that. So the industry is an offer-driven industry for biological reasons that are related to how people look at finance. So how do you put something which is an offer-driven industry onto a pull technology? So, and we get to the point of education. I'll give you this example. When I live in Frankfurt, we mentioned it, and my family lives in Milan. Every weekend I couldn't do during the lockdown, I fly to Milan. And what is my role in the family, Helene, is to do the grocery. So every Saturday morning, I go to the supermarket. And what do? I take from the shelf milk, pasta, the beer. And then I see an advertisement of George Clooney, you know, the American actor. He has a beard like me, and he's using a different shampoo. So I like it, and I decide to change the brand. But when I get to the cashier and I look inside my shopping trolley, I see that everything I bought is basically the same. 95% of the things I buy are always the same. Because grocery, which is e-commerce, you know, where we looked at to think about how to digitize wealth management, is a pull mechanism, is demand-driven, more or less, you know, and Procter & Gamble tries to sell me, you know, a different something. Now, Eric Poon never told me, Paolo, what is going on Amazon? Nothing goes on Amazon. All of the people in our audience are there wanting to buy one of my books, and then Jeff Bezos wants them to buy a different book. That's a fair game, right? But they go with a clear purpose. But when people have money to invest, very few people, and these very few may be the client of an e-trade platform, which represent a very tiny portion of people in the world, would Google, is there an investment fund that has 30% in US stocks, no more than 20% in Chinese stocks, but not those of Guangdong because they pollute, and I am ESG. It doesn't really happen. So they need to get into a conversation. And through that conversation, though they may not understand everything, they trust, and so they make a decision. So now the element that needs to be resolved to make sure that digital wealth management does the next step is effectively this conversational element that provides something invaluable to people, which is the right motivation to act. And that has to be done transparently, especially in digital, because otherwise opacity can go viral and it's not good. Because if you take Robinhood or platforms that are not taking care of the awareness that their clients receive while joining the platform, some might be already capable of self-directing, more they want to try or not, and that becomes damaging. It is not good value for investors, it does become exclusive, and so on and so forth. So now, the only issue is that some fintech entrepreneurs thought that education is normative. That means I tell you what is a bond, tell you what is a fund, that doesn't help people to invest. The problem is to build what I define like the holistic behavioral awareness. It's all about awareness of the fact that the future is open. Everything that the robot tells you or an advisor tells you is an expert opinion, but it doesn't own the future. Uncertainty is the new norm. It has to be behavioral because it's about how you relate with investing, and it has to be holistic because it has to look at your whole balance sheet, right? Don't invest everything into the Bitcoin because if it goes bad, you lose your house. So make sure that you are a prudent, though you can take some risk type of investor. So that's why in my second book of 4, The FinTech Innovation, the subtitle is from goal-based investing from Robo Advisors to goal-based investing and gamification. Because gamification, which doesn't mean making a game like Pac-Man, is the mechanism by which you can help on the platform clients to understand by dry running their investments, by picking up the behavior and learning how they would react given certain market conditions, which open up a bit more the black box of investing, not just from the technology side, but also from the truth side. That is, the future is open for everybody, even for big data, who does not own our future.
Thank you, Paolo. Yeah. I think that's a very interesting one. I'm sure Eric has something to add to that.
Sure. I mean, use an analogy, smartphone. I think smartphone to me is a phone smart enough to help us to make our life easier. I think the same goes with global robo advisors and wealth tech. To answer Shelly's question, thank you for the question, Shelly. I think it's the fact that one has to be able to, in practicality, when they're on the road using the phone, someone will be able to see their balances, see their asset allocation, and even see the deals that they might be looking at. So these are kind of really basics, whereby using a phone and different things. You know, to give you a simple example, have you ever used the iPad, try to type it? If you use like Facebook, you could see it horizontally. If you use Instagram, it couldn't even appear horizontally on the iPad, at least not on mine. Maybe it's my issues. But, you know, in short, even simple, practical, vertical, horizontal screening, the fonts, you know, the fonts are key, especially some of the second and third generation, you know, like me, they probably need to remove glasses to see some of the figures. Again, all these minor details is extremely key. Because when you look at the ecosystem, family offices would be the user, the investor, and advocate. You know, I talked about the three, including the ecosystem. And frankly speaking, if they couldn't even see it and use it effectively, there will be none of it. So, you know, that's my humble 2 cents. Again, I'm sorry, this is overly simplistic and very practical, but these are extremely important in my view.
Thank you. Thank you. We got another question from the audience, and I'd like to, you know, Mikaal, perhaps to address this one first before I turn to Paolo and Eric. Now, this question concerns the kind of operational processes at incumbents and how, you know, fintech challenges, if you like, can actually help to better address that maybe. This audience member is a client of HSBC Private Bank. And ask them why don't they get off placing trades manually via the phone? And then the answer is probably is a requirement. So what do you see as some of the kind of you know, issues that hampers maybe large financial institutions from digitizing more rapidly or from being more innovative? Now, that's more of a blanket statement, but actually what are some of the roadblocks that might be preventing large institutions from innovating rapidly or from, you know, partnering with a firm like SoFi or others, you know, more effectively? Mikaal?
I think I can answer that in one word, and it's inertia. And if we take the example of a big consumer bank in Hong Kong, they have branches to support, they have large, you know, legacy technology, manual operations. I mean, all of these things, you know, require revenue to cover those costs. And until new fintech companies, you know, challenge that and push them, and I think that process has begun to happen, they have absolutely no incentive to change. And what we're going to see is an advancement of fee erosion. You're starting to see that. You're going to see more transparency, all of the things we've discussed. But I think simply speaking, it's inertia. They have very little incentive to change. They will be forced to change. And it's the same, you know, concept that you're seeing in the US in front of our eyes with Amazon. You know, retail is getting disintermediated across the globe. I think financial services will get disintermediated in exactly the same way. where sort of high touch, retail, phone-based consultations, all those things will ultimately go away because there'll be too much pressure on costs to continue to do that. So I think it's only a matter of time. I think Amazon is showing us, what the future looks like.
Yep, thank you, Mikael. So there has been a different school of thoughts that maybe, a big tech can be a big bank in the future. Big banks, even bigger techs. Now, being mindful of time, I'd just like to pick the brains of all three of our distinguished panelists. What do you see as the one or two emerging trends that will be reshaping the whole area after perhaps we settle into a new normal when COVID is a little bit kinder to us? Maybe we start with Paolo.
We're talking about wealth management, I believe. I think it's the realization that has just started that the only way to build differentiated and sustainable businesses is to aggregate into a planning mechanism centered on the goal-based investing, the relationship with the client, because banks and fintech will have to start asking clients to pay for the relationship, as they won't be capable of getting remuneration to the products anymore due to the margin compression, the higher transparency, and the fierce competition. Therefore, it's like thinking of Amazon that offers to its customers Amazon Prime. You would not pay Amazon Prime if you could only buy books. And you would not pay Amazon Prime if you could only buy technical books, novels, and books in foreign languages. So in the wealth management space, it's not about the amount of financial products you have, but you pay Amazon Prime because you have a full suite of services that you can access to. And that is the same here. Many in the fintech thought of unbundling the bank, and now they realize that it's coming due, and it's more and more evident that they should instead bundle it back around the one thing that they have in common: client. Client centricity doesn't mean personalize the individual product to a client. It means restructuring the old banks on digital around that single individual, making sure the barriers are lower so that the relationship can be remunerated, while products, wanting or not, will be minimized.
Thank you. Eric?
Sure, thank you. I think to me, post-COVID, number one, I think the customer has to have good end-to-end experience. By that, I meant from seeing the product all the way to payment. I think that is extremely important. If you could see the product, but you need to wake up tomorrow, go to the bank, or use another internet banking to pay, that's not efficient. Secondly, is perhaps better service. I mean, we have seen so many chat boxes online, and most of them are not effective. I mean, what about for certain client segment at least, or certain time, you have a live person to at least message or chat with you? That would be a lot more friendly. Secondly, differentiated product. To Mikaal's point about Robo 2.0, I think the Robo 3.0 is a lot more differentiated products on there. In the old days, we got the ETF, we got the Robo Advisors, we got different things. What about for accredited investors, real estate, PE, private debt, venture capital, dues, REITs, can it be more comprehensive? What about insurance products? What about trusts? At least, and I think Shirley asked about education, and I think to me is very key, right? What about comprehensive video one can play easily to learn more about what is REITs, for example? So I think the differentiated product and the educational pieces are key. Third, I think ESG. What about ESG and green? There are numerous this type of products on there already, but are there any more, various angle one can learn more about ESG, learn about green, and find especially interesting fund managers and asset managers, be it within the discretionary portfolio or by the fund direct. I think to me, having that would be a great Robo 3.0. Thank you.
Thank you, Eric. You touch upon an area that is very passionate. I'm very passionately committed to, which is ESG. And I do believe that is going to reshape the way in which people look at investing going forward, more than just a CSR or a philanthropy agenda. It is an investment agenda. Yeah.
Absolutely. I mean, Helen, you and I met in the United Nations conference last year, which I
Yes.
organized. So definitely ESG green is definitely here to stay. So from educational to finding differentiated manager product and even learning different types of ESG products on an advisory side, and also having that as part of the Robo Advisory investment portfolio, that could be very interesting.
Absolutely. That could be another webinar, but I'd like to talk to, to gauge Mikaal's thoughts on this as well. Mikaal?
Yes, I think the one thing that continues to drive consumers nuts is the complexity of pricing, and it's been raised by the panelists already. I think it has to get a lot simpler. So I think, wrapping up, I think from my perspective, I think the future is very likely in subscription and flat fee pricing for financial services. The products are getting simpler. The user experience is getting simpler. I think the pricing needs to get a lot simpler as well. And so if we think about a revenue model for fintechs as we go forward, I think subscription pricing is one that is probably going to get more traction. And I think it's something that consumers will prefer as well.
Great. Thank you so much, all the different panelists. It's really an honor to share the podium virtually with all of you.